If you want to know more about cash flows from operating activities, this video will explain the direct and indirect methods of reporting them so you can better understand this part of a firm's cash flows. Firms are required to report their cash flows from operating activities using either the direct or indirect method, and the accounting standards encourage firms to use the direct method. In practice, many of our firms may use both methods, the direct method in the statement of cash flows and the indirect method in a footnote. The direct method of reporting cash flows from operating activities discloses major classes of gross cash receipts and gross cash payments. For most firms, cash flows from operating activities relate to transactions that determine a firm's profit or loss, such as cash receipts from customers from the sale of goods or services, cash payments to suppliers for goods or services and to employees, cash payments of income tax, as well as potentially a few other miscellaneous items such as various forms of other revenue. Usually, some sales are made to customers on credit. For this reason, we cannot simply use the sales figure for a period to represent the cash receipts from customers. To calculate the cash receipts from customers, we include the amount for cash sales, and for sales made on credit, we need to adjust them for the change in the balance of accounts receivable during the period. To do this, we start with cash sales, and we then add credit sales. And to credit sales, we add opening accounts receivable. We can assume this item will become cash during the period, and deduct closing accounts receivable, i.e. credit sales made during the period for which cash has not yet been received. We saw that when we calculate cash receipts from customers, we start with sales. In a similar way, when we calculate cash payments to suppliers, we start with cost of goods sold. Some, perhaps most, of the cost of goods sold will be paid for by our firm on credit. So we need to adjust a firm's cost of goods sold for changes in accounts payable, opening accounts payable minus closing accounts payable. The cash payments to suppliers will also need to be adjusted for changes in inventories. The reason for this is that the cost of goods sold will only include items from inventories that we actually sold. If, for example, our firm increased its level of inventories during the year, its purchases from suppliers will be more than its cost of goods sold. Typically, there are also a wide range of other expenses and revenue that affect the operating cash flows of a business. These include various expenses such as salaries, insurance, electricity and rent that involve the payment of cash during a period. These items are included in the income statement. To calculate the cash paid for these items of expenses and revenue, these items in the income statement often need to be adjusted for accruals and prepayments. For example, for an expense such as insurance, which is usually paid in advance before the expense is incurred, the cash payments for insurance would be the insurance expense in the income statement, plus closing prepaid insurance in the current year's balance sheet, less opening prepaid insurance in the previous year's balance sheet. The indirect method adjusts profit or loss for the effects of transactions of a non-cash nature. Any deferrals or accruals of past or future operating cash receipts or payments, and items of income or expense associated with investing or financing cash flows. For further information on how we account for cash flows from operating activities, go back to Chapter 7, Section 7.3 in the study guide, and also review the Statement of Cash Flows weekly questions. Also answer, write and rate questions on cash flows from operating activities in Peerwise.